Hello everyone, welcome back to our discussion of Chapter 2. Both of these chapters in the first week of our class. So we got some basis of the value chain and things like that in the first chapter. Now we need to talk about cost concepts. Literally, how do we start measuring the cost so that we can compare it against that value, that the revenue that we can bring in by providing value to customers. And so, like we said before, there are different costs depending on what different decisions you are making. And one of the things that helps us to differentiate is being able to decide how costs behave and some of the definitions of what costs are and how we're going to look at them. So we jump in here. The basic definition is a sacrifice of resource. Now, some people would say that means it's something that's paid. And that's somewhat true, but there are things that are costs that are not paid in cash. For instance, depreciation on an asset. When it is used, that's a cost. Okay, it's not costing us cash right now, but it is a sacrifice of resources, meaning that we are giving up using that machine gradually over time. Now, there are some folks in cost accounting that say that we should focus only on the cash flow items. We should ignore depreciation and other non-cash costs, but that's not how this textbook and how we're going to do it. We're going to look at costs that are a little broader than just the cash, but there is some argument that can be made that if it's not costing you cash right now, then it really shouldn't be part of our internal decision making. So when we refer to a cost, okay, it's broader than an expense. Cost would include things like that research and development that happened in the past. That's a cost of producing that product, but it may not be an expense for the current accounting period. All right? The expense is one form of cost, whether it be depreciation, which is non-cash, or expense like utilities that we have to pay in cash, or salaries or wages. And then the other thing that probably we don't think about most of the time is opportunity costs, what we have given up to be able to do a particular product. So if we have limited amount of manufacturing or machines to make a product, and we decide to make product A, then those machines can't be used to make product B, assuming that there's a finite amount of machines to work on, or people, or whatever it is the resource. And so when we have chosen to do one, we have made the choice not to do another. And giving what we gave up for doing B is an opportunity cost. Okay, so we may decide to do a mix of A and B to try to minimize that opportunity cost. But there is an opportunity cost for everything you do. If you going to taking class or paying tuition, okay, you forego something else that you could do. Okay, that's your opportunity cost of going to school. All right, so that's the same thing with a business. Now, as we look at this, how we typically look at it in a financial statement process. The cost that we have run across in many other accounting classes is the cost of goods sold. That is the expense assigned to the products that are sold. It's not how much is still in inventory, it's how much of the costs we have actually used in terms of the stuff we've sold. So the items that were sold during that accounting period, they cost us that much to make or buy or whatever we did to get them. All right, and then we subtract out some different marketing administrative costs to to get our operating profit, that is the excess revenue over the costs that we needed to have, in this case, the expenses necessary to earn that revenue. Now, to get cost of goods sold, all right, you see the calculation, a little bit of the cost of goods sold statement. So you're going to want to pay attention to that, because in our homework, that's one of the things we're going to be doing in terms of calculating. You start with beginning inventory. You add what you buy, or what you cost that you're added, which include the stuff we bought plus, in this case, transportation to get it to us, because that's part of inventory. And that gets our total stuff we got. We add those two together, and that's our goods available. What we started with and what we added is our goods available. We subtract out what we have in ending inventory, and that gives us our cost of goods sold. So that is the formula for calculating cost of goods sold. Now, product costs are recorded as inventory first. So when we pay for certain things or incur certain costs, when they are referred to as product or inventoriable costs, they first go into inventory, and they sit there until the item that made us incur that cost is sold. And then it moves to cost of goods sold. That process of going through the balance sheet or through inventory and then to cost of goods sold is contrasted with marketing and administrative costs, because they are generally referred to as period costs, and they're recorded as expense at the time we use them. There is no inventory for them to go into until that they're sold. So those are treated separately. So a little simpler, you might say. You don't have to worry about inventory or beginning or ending or anything. Period costs get recorded in the period that they happen. Product costs get recorded as inventory first and get only as an expense when that product is sold. And so to differentiate, our first differentiation between two different cost concepts is product costs are generally those that are related to manufacturing. That they add value to that inventory. And period costs are non-manufacturing. So if they didn't have anything to do with the factory, or they didn't have anything to do with the machinery or the people involved in the factory, if they had to do with payroll, or it had to do with marketing, or it had to do with accounting or human resources, they would be treated typically as period costs, the meaning that they are recorded as expenses without going into inventory. So, summary of that idea, okay? Difference between product costs and period costs is how they are treated, as we just mentioned. Now, the next concept that we need to understand is the concept or the difference between direct costs and indirect costs. Now, direct costs are those that can be directly traced to a product. That means that we can see relatively easily, without having to do a whole lot of extra work, what is involved about that material or that cost in our product. For instance, if we are building automobiles, the direct costs include 4 wheels. It's pretty easy to see that you need 4 wheels on that automobile, 4 tires, doors, antenna, exhaust system, right? Engines. Okay, those are direct costs. They easily can trace. If I make 5,000 vehicles, I need 5,000 engines. And if I make 5,000 engines, I need so many pistons and so many of this and so many of that. okay, pieces that I can clearly see in that engine, or if I'm building bookshelves, I need I can see how much lumber approximately I need. Okay, those are direct materials. We usually refer to our direct costs as either direct materials that go into the product, okay, or direct labor, the people who actually work on it. Sometimes we use the term touch, but today so much little is done with actual touching anything. But those who are directly involved in converting the materials into something finished product. Okay, so they're actually, now they may use a robot or a machine to do it, but they are actually involved in transforming that material into the finished product. That's our direct labor. Those two are our direct costs. It's usually relatively straightforward to know how much direct costs go into making something. It's just a matter of determining how much labor it takes to build this bookshelf or this automobile. Okay, how many of each type of material that we can see in our bicycle that we're building, or our chocolate chip cookie that we're baking, or whatever. Indirect costs are what are going to give us more headaches. Okay, they become a little more difficult conceptually because these are costs that don't get used up directly by the product. They don't necessarily go and are easily traced. We know we need them. We need utilities for our factory. We need the lights on. We need the heat to go. We need the electricity to run the machines. But we can't necessarily see how much electricity very easily is needed to make a bookshelf, or to make an automobile, or to make a bicycle. Okay? So these indirect costs are usually referred to as manufacturing overhead. So they still are product costs. They're still manufacturing costs. They still are part of that cost of goods sold ultimately, but they are indirect. So basically all costs that are not direct materials or direct labor. So examples given in the slide: indirect materials, indirect labor, other indirect costs. All right, indirect materials and indirect materials are sometimes a little fuzzy as to which are which. I'm sitting here in my office. I'm looking at a bookshelf. I'm thinking that if I were probably doing this, I would determine that the shelves and the lumber is a direct material. I can easily see that. But I also can notice that there are the places where the little screws have gone into the sides of it. Okay, those screws, okay, they may be considered indirect because I can't necessarily readily see how much they are. They're also a small cost relative to the overall value of this bookshelf. Obviously, they're needed. I can't put it together without them, but we may determine that that's an indirect material. So indirect materials are those that are not as easily traced, usually smaller in amounts. Let's say that there is a glue holding the back to this bookshelf on. That glue would be an indirect material for sure, because it's really hard to see how much glue is used in this bookshelf, because that probably even is different from one to the next. Each bookshelf, though, is going to have the same amount of lumber involved in making the bookshelf. Okay, so the direct materials are a little more straightforward. Indirect materials, with smaller amounts, a little harder to figure out. Indirect labor, the person who put this bookshelf together would be the direct labor. Okay, indirect labor would be all the other people, the person that swept up the shop at the end of the day, the person who supervised the person putting together the bookshelf, the person that repaired the machinery that it was made on. All those people are indirect labor. I can't see them, what they did necessarily, but they're important to to actually accomplishing what we need to. So some ways that we sometimes slice and dice these different costs. Many times you'll see someone refer to direct materials and direct labor as prime costs. Okay, that is the primary. So you'll have a little bit of a homework problem that will have you classify those into various pieces and various buckets, if you will. So direct materials, direct labor can be defined as prime costs. Conversion costs, on the other hand, all right, include typically direct labor and manufacturing overhead. That's the cost to convert those direct materials into a product. So that requires labor, and it requires the overhead, requires the electricity and all that kind of thing to be able to convert that into the finished product. And then some examples of non-manufacturing. Typically, companies will kind of lump them into two big categories: marketing, selling costs sometimes is referred to there, and administrative, just basically everything else. Got to have headquarters, you got to have payroll, you got to have these administrative costs that need to be paid, otherwise the business doesn't operate, but it can't really be tied to the manufacturing, okay? And so therefore, these are period. They get recorded as they are paid, as we mentioned earlier. Now, we move on to another concept. When it comes to indirect costs, because they're not as traceable to a particular product, we can't see how much exactly is used in a product, then what we do often to be able to make decisions is we do some form of cost allocation, which means we know how much electricity we use. We can measure that in total for our factory. But the question is, how much electricity, okay, is we need, okay, to make chocolate chip cookies, a chocolate chip cookie, a batch of chocolate chip cookies, whatever we're measuring. And of course, the answer is we don't know for sure. We're going to come up with an estimate, an allocation that basically says, here's these indirect costs. These costs we know are there, know are necessary, but we can't necessarily tie it to a particular batch of cookies. All right, but we also know that if we don't sell our cookies for enough to cover, okay, those costs, then we're in trouble. So we need to come up with this allocation, because remember, we're trying to figure out if the value of those chocolate chip cookies is going to be exceeds the cost. And part of the cost of making those cookies is electricity. It's harder to see, harder to trace, but we're going to come up with some estimates. And as we go through this entire semester, we're going to hopefully get better and better at doing that estimating. So we're going to do some really rudimentary type estimating here in Chapter 2, and we're going to see other ways of doing it later on. Remember, there's no rules, there's no FASB, there's not anybody saying this is how it has to be done. So this allocation, this estimate, of course, is done different ways, and we're going to look at multiple ways we might do it and how we would come up with that cost of making chocolate chip cookies. So our basic principles are, you define the cost pool, okay? So what collection of costs? It might be all utilities. It might be gas, electric, the whole thing, okay? And then you're going to assign the cost in that cost pool to cost objects, all right? So you're going to say, okay, I had spent this much for the year on electricity, and I made this many batches of cookies, okay? So I can now, that's my cost allocation rule. If I figure that's the best way to determine the cost of electricity for a batch of cookies, that's what I will do, okay? And then I assign, if I made 10 batches of cookies, then I assign the cost that I come up with, all right, for each batch to that situation, those 10 batches that were sold. So the cost of goods sold is going to reflect the electricity for those 10 that were sold based on our per batch allocation that we made, that sort of thing. So you figure out what the costs are involved. You figure out what rule, how you're going to allocate it. Remember, it's an estimate. It's not going to be perfect. And then you assign the costs, which then are going to be used in the process of coming up with cost of goods sold or whatever the decision-making tool we need to use. So, an example, okay? Rockford Corporation has 2 divisions, East and West Coast. Both divisions are reported by the IS group, okay? Information Systems Group. Their cost pool, their department cost of this IS department is $1 million. So the question is, how much of the $1 million of cost needs to be allocated to East Coast and how much to West Coast? All right, so if we determine our cost allocation rule is, we're going to allocate it based on revenue. So you see that East Coast revenue is 4 times higher than West Coast, or you can say that East Coast is 80% of the total and West Coast is 20% of the total. However it makes sense to you, okay, you'll get the same result. But so we're going to basically allocate 80% of the costs to East and 20% to West, or we're going to 4 times as much to East, okay, or 4/5, okay, to the East Coast and 1/5 to the West Coast. Whatever makes the most sense in your head, okay? Assign the cost. The cost object is that percentage. So, going back to our process of calculating cost of goods sold. Remember, we need to know how much of our costs are added to a product during the accounting period, okay? So, with a manufacturing company, we use 3 types of inventory. We learned this in Accounting 160. We're going to review it here, get so that we've mastered this idea. When you buy stuff initially, that's materials you're going to use, either as direct materials or indirect materials. We put it in raw materials inventory. Think of it as a warehouse. It's the stuff we need to use to make our product. Okay? We buy it, we put it in the warehouse until we need to use it. So that's inventory. That's raw materials inventory. I haven't done anything to it. Okay, it's not very valuable, except we could probably sell it for what we paid for it, but we haven't added any value to it. Work in process is stuff that's partially made. So we've gone and got stuff out of the warehouse that we needed to use. We have started the process of making it into a final product, but we're not done yet. Okay? Not finished, and that's work in process, work in progress. I don't care what term you want to use. Okay, those are interchangeable. And when it's done, then it's finished goods. So it starts in raw materials, one pile, and then you get it and you move it into work in process where you work with it for a while, a couple hours, a couple days, a couple months, whatever the process is, okay? And then when it's finished, you move it to another pile, and it's called finished goods. That hasn't been sold yet. That sits there until it's sold, and then it moves to cost of goods sold. All right? So, how do we know how much is on the direct materials inventory? Okay? And how does that flow through there? We start with beginning, raw materials. We add what we buy. Okay? That equals what we have total available. We can't use more than what we had and plus what we bought. Subtract out the ending inventory. This sounds familiar. This was the formula we showed you earlier. And then we end up with raw materials transferred to work in process. If some of the materials were used in as indirect materials, then you would also subtract out, okay, the indirect materials to get direct materials used. So if it's an indirect material, then it's not a direct material used. Okay? So that you have to also account for that idea. As we see, the next step then is we have beginning work in process. See, this process is the same. So start with beginning, Start with what you had when you started the month or the year or whatever accounting period you're using. Add the cost you have added. In this case, the direct materials comes right here from this calculation. So you have to calculate direct materials, and then you can do the work in process piece. Plus direct labor, plus the manufacturing overhead. Okay, all those costs equals total. Okay. Well, and that should say subtract. Okay. Ending it, work in process. That's a typo here. Subtract any work in process inventory equals cost of goods completed and transferred to finished goods, okay, or cost of goods manufactured. So flip those. That should be minus, and that should be equals. That amount is going to come over here. We're going to do the whole process again. Start with beginning finished goods inventory, add our cost of goods completed, equals our goods available for sale, minus our ending, and equals cost of goods sold. Again, they flipped those two. That should be minus, and that should be equals cost of goods sold, which then goes on the income statement. So this is the whole schedule of cost of goods sold. That is going to be one of your homework problems. You're going to work through that whole schedule. So if you'll just do these steps, then you'll get to cost of goods sold. All right. So this is somewhat summarized. Sometimes they will have it actually on the income statement, most of the time not. And usually they have it on a separate schedule. Okay. But this is right on. This is a cost of goods manufactured and sold statement, a separate statement. Beginning, okay, do your whole direct materials pieces, your direct labor, your manufacturing overhead, okay, take out the ending, and you get your cost of goods sold, cost of goods manufactured, and then you do the same thing with finished goods to get our cost of goods sold. So this is a cost of goods manufactured and cost of goods sold statement in one, with the cost of goods sold going to the income statement as $26,200. Subtract that, get your gross margin, talk about your period costs as marketing and administrative, and you get your operating profit before taxes, which is typically how we end our statements from an internal standpoint, because taxes are not critical typically to our internal decision making. All right, so that is how they flow through the statements. That's how it ends up on the income statement, and how you get from the balance sheet. So if we go back to here, these ending finished goods, this ending work in process, all right, this ending raw materials, that's what is going to go on the balance sheet as inventory, those three numbers. That's how it's related, okay? Now, some cost behavior. How do cost behavior, how do they change? That's really what we're talking about with cost behavior, is what makes them change, all right? Do they change because you make more of a product? Do they change just because someone says, because your contract changes? What is it that causes something to change, that cost to change? And the reason why we need to understand cost behavior is so we can predict, so we can see try to see the future. If this happens, what's going to happen to this cost? If we add more product, if we add like we talked about in chapter 1, if we add a food truck, what costs are going to be different? How are they going to behave with that addition of a new food truck? All right. Now, important definition, relevant range. When we talk about the changes in cost, we want to probably narrow it down to a level of activity that makes sense. So, for instance, if we normally sell 1,000 units of a product, and we say, oh, well, what would our cost be if we made 7,000 units. That's probably not relevant. That's so far out of what we would normally do that it's really hard to estimate our costs and to know what they would be. We have some understanding of what it is within a relevant range and the costs and how they behave within that thing. So maybe if it's normal as 1,000, we feel comfortable in knowing how our costs are going to behave from, say, 500 up to 2,000. But we're very uncomfortable with activity that's below 500, because once you get too low, costs start to be really distorted. And when they get higher, way higher than we're used to, that's outside the relevant range, and we would also consider what the cost behavior to be kind of out of the ordinary. So that's not what we're considering. We want to try to narrow it down to a relevant range. So first of all, fixed costs. Fixed costs remain unchanged when volume changes. So as long as we're in the relevant range, as long as our number of items we're making is within kind of our normal production, all right, that means that's going to be the same regardless of that volume. Now, that does not mean that fixed costs don't change or can't change. Now, some fixed costs will sign a multiple-year contract to pay a certain amount, and those won't change. But other fixed costs may go up each year because of inflation. Okay, we may have a rental agreement that says that we pay $1,000 this year and $1,100 that next year and $1,200 the next year. That changes, but it is still a fixed cost because the change was not related to how much volume we did. It didn't have anything to do with the activity. We have to pay that rent whether we make 1 unit or 10,000 units. And our cost of rent is going to go up by the agreement, not by the activity. Okay? So no matter what the activity is, they're going to be fixed in total. But what's really interesting with fixed costs is the more you make of your product, if you take that same fixed cost and divide it by more units, it looks as if your cost per unit goes down. And we're going to talk about that over and over again through the semester, that's a little bit deceiving. It makes you feel like your costs are going down, but they're not. Just because you make more does not make that rent go down. It just kind of feels like it because your rent per unit you made is going down the more you make. Variable costs, okay, maybe the opposite, I don't know if you want to call it the opposite, okay, but they change proportional to the change of volume as long as we stay in the relevant range, as long as it's normal production, okay, which means that they're going to go up when you make more and they're going to go down if you make less. That's what we define it as a variable cost. And they're going to go in a roughly, you make twice as many products, your costs are going to be twice as much. So they're going to be kind of what we call a linear relationship, typically as our assignment, as our assumption. And the cost per unit. So direct materials, for instance, is a typical variable cost. If we make bicycles, okay, and we need direct materials of 2 wheels, then as we make each new bicycle, each additional bicycle will need the cost of 2 wheels. So it should be the same. It's not like you make 50 of them and then the 51st one is going to need 3 wheels or 4 wheels. It's still going to need 2 wheels. Now, the price of wheels may change, okay, and that would change that variable cost per unit, but that is an external determination. We still need 2 wheels, and the cost of whatever those 2 wheels is going to be constant regardless of how many we make. All right? So fixed costs, you might say, during the relevant range is flat from a graphical standpoint. Okay, you would graph that no matter your cost is 100,000 or roughly 100,000 there, whether you make 1,000 units or 5,000 units, or 3,000 units, or 4, or 3,500, or 2,700. Yeah, wouldn't affect your fixed costs. So some costs have both pieces. They can be referred to as semi-variable or mixed costs, which means that there's some part that you pay regardless of some cost that is the same every month, whether you make a lot or a little. So for instance, if I look at my gas bill, I pay $15 a month regardless of how much gas I use. It's just the cost of being connected to the gas company. All right? So that's the same. That's the fixed part. And then the more gas I use, the higher my cost. So that's the variable part. Okay? So because it's based on how much gas I use. So that's together, that would be considered a semi-variable cost. My cost will never go below $15. So it has, or 10 in this example that's given here. All right, but it will go up as we use more gas or whatever the activity is that makes the cost go up. Sometimes referred to as a cost driver. Now, step costs or semi-fixed costs kind of make it a little more difficult, okay? And this is a situation where you have a set cost over a range of activity. So for instance, if I have a retail store and I have employees, then maybe I can operate it as long as there's from 0 to 5 customers in the store, I can have one person cover it. Okay? But at the point that I get more than that, on average, then I need 2 people to cover it. And after I get the more, and that's fine up until I have 10 customers, and then once I have 10 customers or more, I need 3 people, okay, working up there. So that's what we mean by step fixed, semi-fixed, or step cost, is that one person or one machine or something can operate for a certain range, and then it doesn't jump up gradually. It's not like you can add a part of a person as more customers come in. It either has to go from one person to 2 people, okay, and from 2 people to 3 people. You can't go up gradually unless you're willing to just add part-time folks here and there, that sort of thing. But if you're going to put people actually full-time, then you're talking about maybe a step cost. All right, so when we look at product costs and kind of how they operate, okay, you can kind of refer to 3 different ways of looking at it. Okay, the full cost of a product is all the manufacturing costs and all the selling costs, no administrative costs. But we find a way to allocate all of the costs and all of the selling costs. So basically, you say that's what we have to cover that. We have to provide enough value long term for our customers that we cover the full cost of this, everything all the way along the value chain to get to the customer. You have to cover the full cost. Okay? Full absorption cost, right, is all the variable and fixed costs of manufacturing. Okay, that includes your overhead, all of that type of thing. That is what is needed for GAAP reporting, for financial reporting. That's what needs to go on your income statement to be reported to the world. Okay? Variable cost is a way of kind of ignoring fixed costs, because you're saying well, fixed costs aren't going to change whether we make a lot more or less of this product. So let's focus on those things that are going to change. That can be done on a short-term basis for making decisions internally. It cannot be used for financial reporting purposes, and it shouldn't be used in the long term. You have to charge your customers enough to cover all the full cost. But on a short-term basis, you may make decisions based on a variable cost basis, looking at just those things that are going to change from that principle we covered earlier in Chapter 1. Because the variable costs are differential, because they're different based on if we make 3,000 or 2,000 units, the variable costs are going to be different. The fixed costs are not. So they'd be the same regardless of our decision. So in decision making, sometimes it makes more sense to use variable costs. So here's kind of a visual way to picture that. You've got all your variable costs, your direct materials, direct labor, variable manufacturing, and you'll get a chance to do this in your homework, kind of put this together. Variable manufacturing costs then would be those three added together. Then if you wanted to add your fixed manufacturing overhead, then that would be full absorption costs. That's what would go on your income statement to report to the world. Okay? If you were looking at just the variable costs, you would go with direct material, direct labor, variable manufacturing, skip over the fixed manufacturing and go to the variable marketing. Typically just the selling and marketing costs, and administrative costs are typically not included, but there may be some that are specific to that product. But again, you're ignoring anything that's fixed, only those that change with volume. And then the forecast is everything, right? Direct materials, direct labor, variable, fixed manufacturing, variable marketing, fixed marketing, administrative cost. So, as we mentioned earlier, full absorption is required by GAAP, used for financial purposes and external reporting, variable for internal. And notice this, sales revenue minus variable cost equals contribution margin instead of gross margin. If it's sales minus cost of goods sold, it's gross margin. If sales minus variable cost is contribution margin. What does it contribute to covering our fixed costs? So again, remember, we're using costs based on what they're useful for. If it's internal, often the contribution margin income statement is more useful, more helpful in looking at what products to sell, which ones to not sell, which manager to reward, rather than looking at the full thing, because they can't control the whole piece. Okay. So just another way of looking at it, remember, cost of goods sold is usually involves full absorption, has both variable and fixed costs, which means it can be distorted a little bit with more volume. And then these are your period costs, and of course that includes some variable and fixed. All right, so you can see the difference with a variable cost system. You're only looking at those things that are going to change. You would take out the variable and move all the fixed costs to down below. So this would be your variable cost. All the variable manufacturing, all the variable marketing equals your contribution. And remember, move the fixed cost down below. The operating profit is going to be the same, okay, typically, okay. Now there will be situations where when you sell and what you make is two different things, and that will affect operating profit. But for this chapter, we're going to keep that the same. The operating profit, regardless of the way we set it up, will be the same. Okay, it's just a matter of where things are calculated and included. And that is chapter 2. Now you're ready to do your work on your homework and get that completed.